Imagine this, a stock that's plummeted 72% in value, yet billionaires are still piling their money into it. It sounds like a paradox, doesn't it? You'd think that after such a massive drop, investors would be fleeing. But not these billionaires. Warren Buffett's Berkshire Hathaway owns over a third of the company, and top hedge funds like Point72 have sunk nearly $100 million into this struggling business. Why are these financial giants still betting on a company that seems to be falling apart? This is the case with SiriusXM, a satellite radio service that was once a disruptor in the car entertainment world. But as we dive deeper, you'll see that the reasons behind these billionaire investments might not be as clear-cut as they seem. Should you follow their lead, or is there something they know that the rest of us don't? Let's break it down. At the turn of the 21st century, SiriusXM was a game-changer. The company revolutionized car entertainment with its satellite radio service, offering a vast array of music, talk radio, and sports, all commercial-free. Back then, it was a no-brainer. Why settle for local radio when you could have an endless stream of content wherever you went? It was a huge win, especially as automakers bundled SiriusXM subscriptions with car purchases, locking drivers into long-term contracts. But in recent years, everything has changed. Enter Spotify, Apple Music, and YouTube. These music streaming giants have dominated the market, offering not only music but podcasts, audiobooks, and personalized playlists, all at the touch of a button. And it doesn't stop there. CarPlay and Bluetooth integration in modern vehicles make it easier than ever to connect your phone and stream your music directly. Why pay extra for SiriusXM when you have all of this at your fingertips for free? The numbers tell the story. SiriusXM has been losing subscribers for over a year now. In fact, last quarter alone, they lost 68,000 self-pay subscribers. That's not all. Revenue has also started to decline sharply from $9 billion in 2023 to just $8,565 billion in the past year. As more drivers switch to streaming services that offer better connectivity and a wider variety of content, SiriusXM is left struggling to keep up. The company isn't going down without a fight, though. They've spent a lot on securing big-name talents like Stephen A. Smith, Alex Cooper, and Conan O'Brien to attract subscribers. But the question remains, is it enough to keep them competitive? The future doesn't look promising, and competition from Spotify and others only continues to grow. So, where does this leave SiriusXM? Let's take a closer look at why billionaires are still backing the stock despite all of these challenges. Here's where things get interesting. Despite all the struggles and challenges, SiriusXM still has some pretty big names backing it. Warren Buffett's Berkshire Hathaway owns over a third of the company, and hedge funds like Point72 and D.E. Shaw have millions invested in this stock. So why are these financial giants continuing to pour money into a company that's seen its stock fall by a staggering 72% since mid-2023? You'd think that with all the problems SiriusXM is facing, declining subscribers, rising competition, and a mountain of debt, these investors would be backing out. But that's not the case. So, what's really going on here? Are they simply holding on to a bad investment in the hopes of a miracle turnaround, or is there something else at play? Here's a theory. Maybe these billionaires are playing the long game. Despite the short-term struggles, they could be betting on SiriusXM's low P/E ratio and its 5% dividend yield as potential signs of an undervalued stock. But here's the catch. Those metrics don't tell the full story of the company's financial troubles. So, are they seeing something we're missing? Or are they just holding on too long? Let's dig deeper and explore the other side of this investment gamble. At first glance, SiriusXM's stock might seem like an enticing opportunity. The company offers a 5% dividend yield, a pretty high return in today's market, and a price-to-earnings P/E ratio of just 3. That P/E ratio in particular could make the stock appear incredibly cheap. On the surface, it looks like a steal. Who wouldn't want a stock that offers a high dividend yield and a seemingly low P/E ratio? But here's the problem. P/E ratios only tell part of the story. They don't account for the massive debt that SiriusXM is carrying, which is one of the company's biggest red flags. The stock may seem cheap, but beneath that surface is a company that's barely able to cover its interest payments and dividends. The low P/E ratio is deceptive, especially when you consider that the company has over $10 billion in debt and only $100 million in cash on hand. Let's break it down. The company is paying out over $100 million in quarterly interest payments. Add to that the $183 million in dividends paid out in the first half of 2024, and it becomes clear that SiriusXM's cash flow can't keep up with its obligations. In fact, the company's free cash flow is barely enough to cover those interest payments and the dividend. So, while the stock might look attractive based on its dividend and P/E ratio, the financial health of the company tells a different story. Is it really worth the risk to chase those high dividends when the company's long-term viability is uncertain? Let's move on and see why the company's subscriber decline and rising debt could pose even bigger issues for investors. If the low P/E ratio and high dividends aren't enough to convince you that SiriusXM might not be the bargain it appears to be, let's take a deeper look at its subscriber numbers and debt. These are the true indicators of where the company is headed. First, let's talk about subscribers. The company's once thriving customer base has started to shrink. In the most recent quarter, SiriusXM lost 68,000 self-pay subscribers, and that's not an isolated event. For the past few years, the company has been struggling to grow its subscriber base. Why? The rise of streaming services like Spotify, Apple Music, and YouTube Music has left SiriusXM behind. These services provide users with everything they need: music, podcasts, audiobooks, all through their smartphones, and with easier integration into modern car systems via Bluetooth or Apple CarPlay. Why would someone pay extra for SiriusXM when they can stream their entire library for free? The impact of this shift is undeniable. SiriusXM's revenue has dropped as well, from $9 billion in 2023 to $8,565 billion over the last 12 months. This means the company's growth has stagnated, and with more and more consumers moving to music streaming platforms, it's clear that SiriusXM's business model is becoming obsolete. But subscriber loss isn't the only problem. The company is also weighed down by its mountain of debt. SiriusXM has over $10 billion in long-term debt and just over $100 million in cash on hand. That's a significant imbalance for a company struggling to maintain its customer base. To make matters worse, the company is paying over $100 million in interest payments each quarter, which is a massive burden when compared to its relatively low free cash flow of around $1 billion annually. This heavy debt load is a real concern for investors. As the company continues to lose subscribers and revenue, how will it manage these liabilities? With such limited cash flow, SiriusXM may be forced to either refinance its debt at higher rates or, worse yet, cut its dividend. In either scenario, the stock could lose even more value, and the dividends investors rely on could be at risk. The writing is on the wall. SiriusXM's debt and declining subscribers create a dangerous combination that investors need to consider carefully. So is this really a stock worth buying, even with the high dividends? Let's look at the company's financial position next and see if there's any hope for a recovery. Now let's take a closer look at SiriusXM's financial position, because this is where the real warning signs start flashing. While the stock might seem cheap with its low P/E ratio and attractive 5% dividend yield, the company's underlying financials tell a much more concerning story. SiriusXM's market cap is just $7.25 billion, which might sound small, but its enterprise value is a whopping $17 billion. This means the stock is trading at nearly 17 times its free cash flow. On the surface, that could still seem like a bargain, but it's important to remember that this is a company in decline. A high multiple like this suggests that investors are paying a hefty price for a company with stagnant revenue, declining subscribers, and rising debt. Now let's get into the debt situation. SiriusXM is sitting on over $10 billion in long-term debt, and the company only has about $100 million in cash on hand. This is a serious problem for a company with shrinking revenue and a high burn rate. Even though SiriusXM has been able to pay its dividends so far, that could change quickly if the company's financial situation continues to deteriorate. The company's free cash flow of $1 billion annually isn't nearly enough to cover its quarterly interest payments of over $100 million and its dividend payout. As a result, SiriusXM is dangerously close to a situation where it will have to either refinance its debt at higher interest rates or potentially cut its dividend. Both scenarios would put downward pressure on the stock, and with the company's low cash reserves, that could be a very real possibility in the near future. So, while the stock may appear cheap based on its P/E ratio, when you consider the company's debt load and its declining financial performance, it starts to look much riskier. With the way things are going, SiriusXM might not be able to keep up with its obligations, let alone sustain the dividends that make it seem attractive to investors. It's clear that the financial foundation of SiriusXM is shaky at best. Now, let's wrap things up and talk about whether this is a stock you should be buying or avoiding. So, after looking at all the numbers and analyzing the company's situation, it's clear. SiriusXM is not the safe investment it might appear to be on the surface. Yes, the 5% dividend yield and low P/E ratio are enticing, but they don't tell the full story. When you dig deeper, you find a company in decline, losing subscribers, seeing shrinking revenue, and struggling under a massive debt load. The company's debt is far too high for a business that's barely covering its interest payments and dividends with its free cash flow. And while billionaires like Warren Buffett and hedge funds like Point72 have sunk money into SiriusXM, it's important to remember that these investors can afford to take risks, and they may have a much longer-term strategy than most retail investors. For the average investor, the risks here far outweigh the potential rewards. In addition, the competition from Spotify, Apple Music, and other streaming services isn't going away. In fact, it's only getting worse. With modern cars becoming more connected to these streaming platforms, the need for a SiriusXM subscription is rapidly disappearing. SiriusXM's business model is becoming obsolete in the face of changing technology and consumer preferences. As the company continues to struggle with subscriber retention and rising costs, there's no clear path to recovery. In short, while it may be tempting to buy into the stock because it looks cheap, the company's financial instability and declining performance make it a risky bet. Even with billionaire backing and high dividends, SiriusXM is far from a safe investment. If you're looking for stable returns and a healthier investment opportunity, you'd be better off looking at other stocks that are better positioned for growth and sustainability. SiriusXM may seem like a bargain, but it's a risk that could cost you in the long run. Conclusion: to sum it up, SiriusXM may not be the right investment for most people right now. Even with its seemingly cheap stock price and high dividends, the company's debt, declining subscriber base, and shrinking revenue make it a dangerous choice. If you're looking for more stable, high-potential investments, you're better off exploring other options that have a clearer path to growth. Stay cautious, and don't be swayed by the short-term allure of high dividends. The long-term outlook for SiriusXM is uncertain, and the risks simply aren't worth the reward. To wrap it all up, SiriusXM might seem like a tempting investment with its low P/E ratio and 5% dividend yield, but when you look closer, the company is in a precarious financial position. Despite the support from billionaires like Warren Buffett, the reality is that SiriusXM is struggling to maintain its subscriber base, dealing with rising competition from streaming giants like Spotify and Apple Music, and is drowning in debt. The decline in subscribers, combined with the company's inability to generate enough free cash flow to cover its debt and dividends, means that its future is uncertain. The risk of a dividend cut or further stock price decline is high, especially if the company doesn't manage to turn things around soon. As investors, it's easy to be lured in by the high dividends and cheap stock price. But the truth is that SiriusXM is facing significant challenges. The financial instability, coupled with a fading business model, makes this stock more of a dangerous gamble than a smart investment. If you're looking for a stable and promising investment, there are far better opportunities out there. So, take a step back and evaluate whether SiriusXM is really worth the risk. Don't let the flashy numbers fool you. The company's fundamentals are much weaker than they appear. So, in conclusion, it's wise to avoid SiriusXM for now. Focus your investments on companies with stronger growth potential and financial stability. Trust me, your portfolio will thank you later.